David, good to see you. Last time we spoke was in December of 2024, and feels like it was years ago because of the state of things, at least to me. I don't know about you.
Plenty happening from a public policy standpoint, from a markets perspective. There's plenty happening.
So, I've been starting off with some people, and I'm gonna do this with you in regards to, what is your biggest concern right now, or not even concern, but what's at the top of your mind as you're seeing what's happening with the markets, your industry, and just the state of things.
I think my biggest concern is the timing gap between policy implementation and the effects. We see a lot coming out of the Trump administration, and there's, at least in theory, the potential for it gaining some significant growth-oriented traction. How it's executed remains to be seen. If it's executed well, remains to be seen. But in theory, there's some ways to grow the economy. Um, all of the proposals do have uncertainty attached to them, and that uncertainty rattles the markets. So the gap between is particularly concerning in this particular time frame because you've got the Fed who is less likely to intervene in a market sell-off as they typically do. The president's working group on financial markets, sometimes referred to as the plunge protection team, uh, you could argue that they're somewhat on hold, not willing to intervene until they've got greater clarity as to what the implications are of our trade policy, tariff policies, and things of this nature. And so it means that there's probably more risk in the equity markets with less support, and I'm not sure that's fully appreciated. So again, the concern is the gap between this is what we want to do and does it work or does it not work? Well, even if it does work, you've still got the time frame where that uncertainty exists, and financial markets really don't know what to do with unknowns.
What were your thoughts on the team that the Trump administration put together in terms of the Treasury Secretary, Howard Lutnick's role, the recent crypto summit?
It's an impressive team. They're experienced in the financial markets. They understand the complexity of asset price movements and correlations. And so less academic, more practical experience. That's intriguing to me.
And then what about the role that Elon is playing in all this in regards to Doge and USAID and
If finding where there's fat to be cut is something that sometimes requires an outsider. If you're doing a corporate restructuring, typically the last thing you want is somebody who's inside the company to be orchestrating it because they've got biases as to what they think is really, really important to stay. The outsider coming in and looking with fresh eyes is sometimes really helpful. Can be disruptive to the culture, but if you're looking for stopping the bleeding, and I'm thinking about a corporate restructuring, not necessarily a country restructuring, but I think the principle applies. He doesn't need anything from this except perhaps at the end of his life to say I made a difference and I made things better. And so there is a contrast between the kind of person you could engage where, you know, somebody's got a net worth of $2 million and would love to see it at 50. They may want to restructure for their own benefit. How do I get my beak sharpened here? That's not the case with Elon. I think, to have all the money in the world suggests that the one thing that he may not have is sort of the meaning and significance piece in life. And so to be able to say, I helped make America a better place, and these are the reforms that we put in place, and we found the waste, and we made things better. I think his motivations are strong, and I think the benefit to him is deeply personal, not financial. That's rare to find, and so the opportunity is intriguing. He is a fresh set of eyes, and he's going to look at things from a fairly unconventional perspective. Um, so, you know, being able to deliver significant, budgetary cuts will be good. I think the fraud and sort of abuses, some of which he's begun to uncover, give some latitude in terms of our budget deficit, which wouldn't have existed otherwise. Because you've got the required spending, whether it's Social Security, Medicare, Medicaid, and then you've got all the stuff that's optional. And there's just not a lot of the optional stuff that you could cut. Let's say you could cut a maximum $200 billion from all of your optional. The real cuts need to take place in places that are too politically sensitive. Medicare, Medicaid, Social Security. You're really stepping on toes there from an electric standpoint. Except if he's able to find fraud and abuse in the system as opposed to cutting benefits to actual people. You know, there's checks going out, Social Security checks going out to people who've been dead for 20 years. That's worth cutting. And you're really not stepping on toes except the toes of bad actors. So if they can do some good work there, I think it's good work.
Yeah, and this is where I'm getting a lot of slack because I keep bringing up the same conversation that I had a few weeks ago with my friend Matt Smith, and but I think it's at the top of my mind right now as I'm watching this whole thing unfold. Now, whether or not it's going to occur or not, it's a theory. But the Mar-a-Lago Accord, and I don't know how familiar you are with some of that stuff, but the Sovereign Wealth Fund, and in regards to, are they trying to crash this thing on intentionally? One, because it benefits Trump's administration for this to happen early rather than middle of next year. Earlier the better, because the thought is to get on the other side of it before the midterms. Also, are we at the end of the line here in terms of our this debt cycle? And with that, with Doge and exposing USAID, to show the masses, this system is just not salvageable. We can't pay our way out of it.
Well, so by crash this thing, what do you mean?
Like for the stock market, what it's doing right now to bring this thing down. What's the impact it's going to have on real estate in terms of that decreasing or dropping. And maybe I shouldn't use the word crash, but to significantly decrease values and devalue the dollar at the same time.
Um, I think those are coincidental things and not necessarily intentional outcomes. Crashing the market is not something that Trump would want to see. If you look at his first administration, he was sort of chest pounding and slapping his own back as the stock market went higher, taking full credit for it. So I think he's not wanting to be in a position where he could be blamed for having created chaos. Um, that just happens to be a function of the frailties in the system today. Oh, too much leverage in the system today, too many bets. You could look at a number of things, whether it's, margin debt, coming close to, as we started the year, close to $1 trillion. You're confident in your bets on Nvidia, so you borrow money from your broker to increase the bet because you're so sure that it only goes up and it never goes down. That's a weak bet. If you look at the leverage within the hedge fund community, they don't leverage 20%, 30%. They leverage 100, 200, 500%. If you look at the leverage that's in trades like the basis trade, there you're talking about leverage that's 10 and 20 times the base investment. We have a very leveraged system, and that means that any hiccups at all have a much greater impact. Forced liquidations occur, and I think that's what we've seen. Financial Times ran a piece on Monday talking about hedge funds being in that position where we're deleveraging and they're being forced to choose what part of their portfolios they're gonna sell off, sort of degrossing as it's called. So I think that the market function, you know, kind of set up the way when Reagan came in. There's a lot of ideas being promoted, and we were ready for a recession. We were ready for a market sell-off, and I think you could say that we were already in a position for a recession and a market sell-off. And what it needed was a little bit of a push. That push could have been anything. It could have been an acceleration of the conflict and an increase of the conflict between Russia and Ukraine. It could be, an OSIRIC 2.0 where Israel's going after Iranian fissile material. It could have been a number of things. It happened to be policies that the world doesn't know what to do with. What are the implications of tariffs on aluminum, on steel, on, counter tariffs to us, on agricultural products? And without knowing, being able to pencil out the implications, markets are turning negative. So that the sentiment is shifting because of the unknowns. But sentiment, what I'm saying is that sentiment could have shifted for a variety of reasons, and it happens to be the policy uncertainty, or the uncertainty that's coming from the policies being implemented. Mar-a-Lago Accord is an interesting concept, and a lot of it is speculation outside of Stephen Moran's comments and some of the things that he's written over the last 6 months, which you basically argue for a reindustrialization of the U.S. and for an increase in exports and a decrease in imports. And part of that, if you read him carefully, implies a lower dollar value as a desired outcome. So, they don't want to lose reserve currency status. They don't want to lose their stature or the importance within the global financial systems, but they do want to gain an advantage in terms of, manufacturing base here in the United States being bulked up and our goods being provided to the world. The biggest effect economically here in the US being an increase in quality jobs. Uh, Tens of thousands, hundreds of thousands of those jobs previously being exported to our trade partners, where we're playing basically an arbitrage game on labor. Get the same products but less input costs, and the consumer is going to be happy. And that's the big rethink. Besant recently saying what the American dream is not is buying cheap goods from the world. The American dream is being able to work hard and succeed and create wealth. And it's not, some sort of a consumer tease where, my flat screen television is $80 cheaper this year than last year, and it's 6 inches wider, and I'm doing so much better as an American. That's not the vision that Besant has. That's not the vision that the White House has of what it means to make America great again. So the fact is, your flat screen television might cost more next year. The hope is that your income more than compensates for that as we increase individual wealth, individual incomes, and create a better job platform going forward. So I'm intrigued by what is implicit in what they're saying, what it means for a lower dollar value, and also super intrigued by the sovereign wealth fund. It's something that other countries have done, and it's something we should definitely pursue. Being able to strategically invest in areas that give us an edge, whether it's over China or Europe or what have you. Um, it makes sense. We're a little bit different, than say some of your Scandinavian countries who have massive funds to work with, coming from their export of, say, oil and gas. Same thing with the sovereign wealth funds in the Middle East. They're dealing with trade surpluses that give them the flexibility to invest the excess. We're not really in that place. We're running not only budget deficits, but trade deficits. So in my mind, a sovereign wealth fund is kind of a theoretical construct today. We don't have the money to fund it. The only way to fund it would basically be to say, but let's count all the real estate in America and all the land that, what's that worth? And maybe we sell some of that off to fund a sovereign wealth fund. I'm not exactly sure, we're just not there yet in terms of running our own trade surpluses or budget surpluses. We haven't run a trade surplus. We haven't run a budget surplus since Clinton.
Well, and wasn't Howard Lutnick? He was talking about Anwar and TikTok and potentially all the gold that's been repatriated back.
Um, yeah, I mean, these are potential assets. it still takes, where's the money come from to buy them? And that's where you need to have some flows of funds to be able to say, here's what we're doing with our capital, liquid capital, to turn it into illiquid capital investments that we think make sense going forward. That's the piece they haven't solved yet, is where's the money going to come from?
I think can't they just put this stuff in the sovereign wealth fund and say, oh, gold is worth 10 million an ounce and TikTok is worth. That's where when I see Howard Lutnick speak, it just reminds me of, oh, we'll just throw it in there. We'll just throw it in there, and it's worth this.
Yeah, I mean, it's the advantage of having a printing press and being able to create money out of nothing. This is not something that you could have considered under the gold standard. Today's sort of fiat money system does give you the flexibility of saying, how much do you need? We'll just create that as a bookkeeping entry. What's TikTok worth? $10 billion. We can create that in digital ones and zeros out of nothing. Okay. Yeah, I mean, I suppose we can do that, but to me, there's a bit of an unreality to it.
If in fact this is what's going on, this Mar-a-Lago Accord, and moving us into this new system, what do you, what is the short term, or what is the pain that regular Americans are going to feel from this?
Well, what the administration has said is you can expect higher prices. So inflation is sort of an expected outcome, but not the kind of inflation we've had where it's 2% this year, 5% this year, 9% this year, kind of graduating, and then with the expectation of it's just going to continue. They're making the case that if we bring domestic production to a level that increases jobs, et cetera, there'll be a one-time increase in products. If all of the parts and pieces for a Ford truck are manufactured here, and we're not getting some of it from Mexico and some of it from Canada, your F-150 is going to be more expensive by $7,000 or whatever it is. I'm just making that number up. But once you've made that adjustment, it's not 7,000 this year, 7,000 next year. We're not talking about an inflation ramp. We're talking about a step up and then a plateau. And the net benefit is we now are in a position to be able to create wealth for the middle class and the average Joe Sixpack who's got a great job, great benefits, great income, and is now recycling those dollars into the economy. That's the argument. I don't know how it's going to work because there's some other things that you have to keep in mind. The Mar-a-Lago Accord is something of a step back from the system as we've had it, which is, we create IOUs out of nothing, treasuries, and we import everything that we need from the world, and we basically pay them with garbage paper, monopoly money. And that's actually a pretty sweetheart deal when you can buy anything you want in the world with monopoly money. So to change the system in some way and leave behind what has been, um, kind of a sweetheart deal. I think we have to be careful. We have to be careful to not be too idealistic. And, there are some changes that can be made. Um, I'm just not sure that they're looking at the fallout of shifting the structure, which has benefited us for the last, let's call it since 1971, or even going back to Bretton Woods. The system has disproportionately benefited us compared to the rest of the world. And does it have its drawbacks? Does it have its weaknesses? Absolutely. You know, in the last 40 years, have we gutted our manufacturing? Yes. Is that symptomatic of the system that we have? Yes. If you want to change one piece, you just have to be careful of the unintended consequences that might change at the same time. And the reality is we still rely on foreign capital to finance our deficits. If you're going through this sort of Mar-a-Lago Accord process, it how exactly do you intend to continue to fund our deficits? It's not clear that you can say, well, we're not going to have deficits anymore. Maybe it's a lack of imagination on my part, Maybe it is just a time gap issue between policy implementation and success, and we've got a rough patch in between where no, we're not funding our deficits, but someday we'll be able to. But it's not clear, and they're not communicating very clearly in terms of what that looks like. Um, so you've got the ideal of a new system and a new Bretton Woods via the Mar-a-Lago Accord. Um, but I think it just needs to be flushed out and talked about a little bit more. I'm not sure that they want to talk about it publicly, because the more you do, the more you have to deal with the barrage of, intellectual critique. So maybe it is just sort of like the closed door. The executive committee has said, here's what we're going to do. We're going to get it implemented. It'll work. We're not looking for middle management input. We're just going to get this done. And it has that feel like you've got some smart people, some brash people. They're like, we're not here to, see what the general public thinks here. We're going to do what's best for the general public. And we're not going to get it all right, but you'll like most of the results. Obviously, you've got half of the electorate which isn't comfortable with that. And you've got, the entire sort of democratic and your swamp creatures within the GOP who are not comfortable with that either, because changing the system has implications for them, huge implications for them. Um, and that may be why, in a second administration, he's not looking for, you know, making policy decisions on the basis of consensus. It's just going to be what it is. Get some smart people together, people who aren't swamp creatures. Let's get some stuff done.
Why the lack of transparency, do you think, on the communication of what they may or may not be doing?
Well, one possibility is that it's not very well thought out, and they're just flying by the seat of their pants. So the ability to articulate isn't even there. That's one possibility. Another possibility is that what good does it do when you've got the news media who will shred you, and they'll take even what you say and miscommunicate it to the general public. So you're just working against yourself to be public. And so I would say it's not an effort to be non-transparent. It's just that very much transparency works against you, given sort of the how unhealthy the news media engages with anything today.
How would the Federal Reserve play a part in all this then?
I don't know. I don't know. It's going to be a year and a half before we have anybody in Jerome Powell's seat that might more directly play ball with Trump. Um, Pragmatically, that could be helpful. Theoretically, that's dangerous in the sense that the Fed should be politically independent. So, you know, how the Fed engages, remains to be seen.
And the reason I ask you that, if we're moving into a new type of Bretton Woods, what possibly could this be attached to? I mean, could you see a gold standard, or this crypto summit is another thing that I'm just very curious about right now that they had last week. I mean, would it be
Yeah,
something like that, or
you can't tie it to anything with limited supply. I mean, we're past the gold standard era. If we wanted to, we could implement it. Louis Lehrman's written a short book on how easy it is to implement the gold standard, but we have a system of governmental promise making that makes it impossible to go back to the gold standard. There's something inherently in conflict with a democracy and a gold standard. As long as you're working in a more republican form of government, like as in a republic, um, or a monarchy, where you've got limited inputs from the street. That's where I think the gold standard can work, because you're not taking a straw poll and you're not worried about the election cycle. In a democracy, it just doesn't fly. It doesn't fly. And this was a point that one of our guests made um, probably 10 years ago, Guilio Galrodi, um, basically said, you know, when you can figure out how to vote your self-interest, you will. And so universal suffrage brings about the politicization of the budget. And so, we've said yes to universal suffrage, we've said yes to democracy. Okay, fine. If socially we agree that that's where we want to be, just know that there's a trade-off there. And you have politicized the budget, and there is no way to have a sound money system backing that. So, whether it's crypto or gold, it has to be unlimited in terms of the ability to increase money and credit, um, unless we're willing to look at other trade-offs. Depoliticize the budget, de-democratize. What are the odds of that happening? Um, so, yeah, I'm less intrigued by the crypto summit, in part because I see crypto as an expression of financial market excess. It's an aberration at the end of a credit cycle where you've got so much liquidity running around that it can become, and flow into anything. And that's typical. Like if you look at past credit cycles, you get the most wild-eyed ideas at the end of a credit cycle. So that the Trump administration is sort of tying itself to the crypto mast, I think is a pretty dangerous thing, because you could deal with some real credibility issues within crypto land. And you know, furthermore, creating a reserve of crypto just puts a target on the crypto market's back in terms of it now being something that you can use as a foreign actor, to upset the credibility of that regime. I would see, Chinese hacking, North Korean hacking. You create a Bitcoin and Ethereum reserve, and it's now target number one for your North Korean hackers. And it was only a few weeks ago that $1.5 billion exited from one of the largest exchanges, and these were supposed to be in cold wallets, one of the safer ways of storing your cryptocurrency. 1.5 billion is a decent heist. There is a difference between Fort Knox and a cold wallet. Fort Knox has never been, and you may have a bad actor on the inside. I mean, we still don't know what the total count of bars is at Fort Knox. But I think you can assume that whether it's leased out or lent out or whatever, there's still a certain number of bars there. With a cold wallet and crypto, when it's gone, it's gone. Like, goodbye. So I think it's a little foolish, actually, to put so much emphasis on something that doesn't have any of the qualities of a reserve asset, and can't actually be kept safe. And this could be totally naive on my part. You'll probably have 1,000 comments in your comment section on this. Um, but explain to me how a cold wallet gets hacked for $1.5 billion, and then please help me understand how I can consider this to be a safe asset to put reserves into. It's a popular asset. Lots of people own it. Maybe it goes up, maybe it goes down. I think the more liquidity that gets taken out of the financial markets and the more stress we see in equities, the more that liquidity constraint is going to have a knock-on effect within every speculative iteration, crypto being one of those speculative iterations.
Well, and you said something. They're trying to think outside of the box and you know try all the Hail Marys. And so, is that what you think this crypto summit is? An attempt because we are at the end of the cycle? Do you think we're at the end of the cycle, David?
End of a credit cycle? Absolutely. Yeah, we are at the end of a credit cycle. And this has been a multi-decade process, not just in the last few quarters. Um, the last major shift was from the global financial crisis to the present, where we've blown up central bank balance sheets, and we've seen the amount of sovereign debt explode, from 2011 to the present. to levels that are just not sustainable. And so, you know, this is a super cycle which is coming to an end. And that's again why, whether it's equities or corporate credit or, high flying tech stocks, AI stocks, there's a lot of risk that I don't think is advisable for an investor to be taking. Because as the tide goes out, it kind of doesn't matter what vehicle you're in. Perhaps the only exception of that is very short-term treasuries, gold and silver. They've been bucking the trend pretty significantly. Even on a day where, and it's not just this day, but it's every day this week and last week. If you're looking at market volatility carrying over from last week to this week, equities are down, gold's up. Equities are down, gold's up. Equities are down, gold's up. And it's something is happening here, which we got to figure out what it means. And I'm not claiming to have an answer there. I think what it means is global actors are looking at the degree of uncertainty that's being created by the Trump administration. And this is, implications into international relations, domestic policy, global trade policy, and people want some insurance. People want something that they have control of, and they want something that can't be monkeyed with in terms of counterparty risk. Same dynamic that we saw in 2008 and 2009, where hedge funds, which would never have owned gold in their lives because they'd much rather have leveraged equity positions or structured financial positions, all of a sudden they want to own physical gold. Why? Because they remove counterparty risk. And you go back to 2008 and 2009, Bear Stearns is gone. AIG is getting ready to fail. And you start realizing that the assets that you think you have on deposit and these companies' liabilities, which are theoretically to be paid to you, they may not exist. They could go up in smoke. All of a sudden, when counterparty risk becomes an issue, gold becomes a priority. We saw that happen at the level of central banks in 2022, where we seized 300 billion in Russian assets, and central bank community says, I didn't know that the US Treasury Department was a bad counterparty, or the ECB is a bad counterparty. We can't trust it. They could just say, you don't have access to your money. So we had the expression of counterparty risk mitigation starting in 2022 with central banks rolling back and saying, maybe it's not just treasuries we want to own. Maybe we need tons of gold in our own vaults if we're going to maintain autonomy, maintain agency, implement policies that we think are best for our country outside of what the State Department and Treasury Department are dictating to us in the moment. If we want to maintain that autonomy, if we want to maintain some sort of national identity where we do what we want to do versus what we're being told to do, we need more of a guarantee. We need control. So I think you're just seeing that migration. Central banks were the big ones to do that. And they did that starting in 2022. They've been aggressively doing that 1,000 tons per year since 2019. And the investment community is just getting on board. And I think the fascinating thing about the metals markets today is that we're just now in the last 3 weeks, beginning to see the migration of assets from high risk to lower risk. By high risk, I mean the AI trades, the tech trades, the crypto trades, and every leveraged iteration that Wall Street traders have enjoyed. Retail speculators, hedge funds, et cetera, they're selling one asset and they're migrating to something that they believe gives them viability when the markets are under greater stress. So fascinated by the movement in the metals, particularly in contrast to the broader markets.
Well, would you also say, people are in that batten down the hatches, brace for impact type of mode, and they want to protect what they have, so they're moving into the precious metals more so and getting away from the AI?
Hedge funds and hedge funds and family offices, I think more sophisticated investors have already started to make that move. But anytime someone comes late to a trade, um, they didn't necessarily buy it for the right reasons. If the hype of AI is what drew you in, and all of a sudden the trade's moving against you, very few retail investors have the disciplines necessary for their first loss to be their best loss. They'll ride that baby into the ground. Why? They didn't buy on a rational basis, they bought on emotion. And the only thing that's going to move them again is emotion on the other end of the spectrum. So they bought on greed, they sell on fear. And we're not at that level yet. You still have most of your CNBC commentators just saying buy the dip, and this is fantastic. If you thought, Nvidia at 150 was expensive, it is your lucky day. Back up the truck at 115. 20% discount for one of the greatest companies of all time. It's going to change everything. I mean, that so that the greed feeling is still in retail, even while hedge funds are saying, yeah, yeah, we need to get liquid. Yeah, yeah, we need to degross. We need to make sure that we've got enough liquidity. We don't know where this is going to end. And the retail investor is not thinking, will the president's working group in financial markets save our butts? Because they don't even know that that group exists. Head of the CFTC, head of the SEC. When things start to come unglued, you put the cobble together who can move the needle, stabilizing the system and keeping panic from becoming, 1929 style, 1930 style crash, 89% down in a short period of time. That's why that group exists. Hedge funds are the ones, leverage speculators are the ones saying, we're not sure that Jerome Powell is going to suck up to the White House and the Oval Office and do his bidding. We're pretty sure that Jerome Powell sees the need for political independence. And just because Trump is creating uncertainty via his trade and tariff policies doesn't mean that Jerome Powell is going to say, and the implications, we'll have them covered. Don't worry about it. Okay, so I think it is your highly intelligent, highly professional leverage speculator that is second guessing how much they've got in play and reducing some of their exposures. Retail investor is going to get run over.
Do you think we're in a state of a potential 1929 right now with what's occurring in the markets?
I think that if you look at the behavior of equities, um, you've got the potential for a cascade decline. I don't know that we'd see as deep a decline as that, but 1987 was pretty severe. It was fairly short-lived, and it was not sort of systemic in terms of the problems. You had trade issues and trade flow issues relating to shorting the market and what was called portfolio insurance in the 80s, which ended up working against the system in the short run. We've got bigger issues in play today than we had in 87. We've got bigger issues, frankly, than we had in 1929. We just have more tools to address those issues. The question is, how quickly are those tools used? And I think for the leverage speculator, that is what's in question now. If we get serious market declines, when? When does the Fed step in? When is there a round of quantitative easing? When is there an intervention that brings stability and calm to the market? And there's no clear answer to that, given kind of the divide between Fed policy and what the Fed wants to do on a wait and see basis, and the White House, which is going, full steam ahead with their policy changes. Could we see a market crash? Um, Maybe. What are the probabilities? 50-50, 60-40? I don't know. I think it's interesting that all of your major markets are, I'm talking about the S&P, Russell, the Dow Transports, they're all trading below their 200-day moving average. And so from a technical perspective, we've had a multi-day close below the 200-day moving average, and your technicians now have to say, regardless of our bullish bias, we have to respond to a technical break. And this is a real break. Not like a dip below support and now we're backing off to the races. Market technicians are looking at this as a significant issue, and so the pile-on effect um, could be there, could very well be there. We've got options expiration coming out 7, 8 days from now. So there's the potential for a major ramp in prices. The question will be if they can get a rally going, does it get back above those significant moving averages, your 200-day, your 100-day moving averages? How much of a rally can they get going between here and triple which is your options expirations? Excuse me. So market dynamics are pretty interesting over the next 10 days to 2 weeks.
What an incredible time we're living in right now, David.
No joke. Excuse me.
And probably my parents had thought that at one point. My grandparents had thought that as well. But I just feel like where we're at right now, and you and I, shared our ages, and we're close in age, and I don't know if it's a benefit that we are where we are, being that we're not. I mean, my mom's going to be 73. Uh, you know, our generation doesn't have grandparents left, uh, because maybe because we knew a different world than where we're at now. But where this is going and potentially the changes that are coming, it's just incredible to me.
Yeah, and I think, there is the potential for policies being put in motion to be a renaissance for business growth and economic activity in the United States. Um, but there is also the possibility that with best intentions and a decent strategy, that the implementation doesn't come off as they hoped it would, and that this is catastrophic to the dollar, our financial markets, and our standing globally. Um, we don't know yet. We don't know yet. So, if you've got a lot of risk in your portfolio, does it make sense to keep it? No, it doesn't. It does not. Um, this is a period of time where, you know, owning tangible assets makes sense. Our wealth management group focuses on hard assets only. It's a unique niche between infrastructure, global natural resources, precious metals mining companies. If you can stub your toe on it, we're interested in it. There are ways to play the equities markets today that I think leave you with a better risk reward setup. If you're not doing something like that, then you should be raising cash. You shouldn't have your 401k fully invested. You should look for a money market fund alternative. You should be creating something of a hedge position, both with the geopolitical risk that is growing, and a currency hedge with the stated intention of devaluing the dollar. Stephen Moran could not have been clearer. We're going to have a weaker dollar. What does that mean for a consumer? What does that mean for a saver? What does that mean for an investor? I, I translate that pretty simply. You want to have assets that are somewhat immune to dollar devaluation. Hard assets fit that bill. If you're not interested in having equity exposure, diversified portfolio of hard asset companies, then just own the stuff. Own gold, own silver, and 2 years from now, 3 years from now, you'll be in a position to take those ounces and redeploy them, I think, into high quality U.S. companies, global companies, at a fraction of the current price. Um, so I think in this case, your best offense is a good defense, and I would highly consider gold and silver. I think the challenge for many investors is how do you wrap your mind around gold knocking on the door of $3,000 an ounce today? It's not cheap, and it's not cheap. The mechanisms and the catalysts are there for gold to trade to between 5 and 8,000 an ounce. Um, the good news is if you own it, you benefit from that. The bad news is if you don't, the reasons why gold got there are generally a degree of chaos and uncertainty that are unprecedented, certainly in our lifetime. So to your point, you know, we are dealing with an amount of change and not only quantity, but the speed with which things are changing, that are they're tough. They're tough for markets to fully absorb. And I think until we have clarity as to where the economy is going, and if the policies being proposed and implemented are in fact gaining traction and working, there's a good reason to hold reserves in cash, hold reserves in silver, hold reserves in gold, just hold reserves.
If you were somebody who had X amount of dollars, let's just say 10,000 to make it even, make it simple. And you're looking at cash, precious metals. What would you suggest in terms of how you would break it down percentage wise? Gold, silver, and liquid.
Um, 5,000 still in cash, 3,000 silver, 2,000 gold. That's assuming somebody doesn't need income, and frankly, you can't generate enough income off of $10,000 to matter anyway. So that's just if you scaled that up to 100,000 or $1 million, you can generate some decent cash flow. But at $10,000, like you want liquidity and you want protection. And so it's almost like a barbell approach. On one side of the barbell, you've got your cash position. The other side of the barbell is physical metals. The reason why I'd favor silver a little bit more than gold is because the current ratio at 88 to 1 ratio is pretty simple. You're just looking at how many ounces of gold have the same monetary value as an ounce of or ounces of silver have the same monetary value as an ounce of gold. So 1 ounce of gold today equals 88 ounces of silver. That number should be different. That number typically is 20 to 30 ounces less, which suggests that silver is cheaper than gold, which is why I would say, of the remaining 5 grand, I'd have two in gold, three in silver. Um, Gold is owned by the largest pools of capital in the world. Silver's not. Silver just happens to be undervalued relative to gold. And as more people look at a $3,000 gold price and say, I can't wrap my mind around that, it's all-time highs, I'm not interested. All right. Well, silver's, 55 to 60% of its previous highs and has room to move. That ratio at 88 to 1, seeing it trade to 75 within the next few months is easy. Seeing it trade to 65 even by the end of this year, all things being equal, if gold remains at today's 29.82 divided by 65 puts silver at $45. $45 off of a current $33. It's about a 50% gain. Gold doesn't have to move another dollar, and silver is just playing catch up to a normal ratio. And 65 is not an aggressive number. So if I'm looking at allocating capital, I want my optionality kept open with half being in cash. And I want to focus on value in the physical metals. And I don't want to be too stupid about only focusing on what's cheap. I still need to hold what central banks and the largest money pools in the world are going to now for good reason. It's geopolitical insurance. You think of gold as inflation insurance, whatever. It's not as good as an inflation hedge as it is geopolitical hedge. And we are in a period of time where if you don't have a geopolitical hedge, you should probably get one, right? So balancing out a gold silver position, still keeping gold in the mix, biasing towards silver because of the value proposition, keeping your optionality open. That's what I'd do with 10 grand.
So you're telling me I need to buy silver, is what you're saying?
A little bit,
Yeah.
few ounces.
The you know, with that, do you see parallels right now between what they're attempting to do, if in fact this is the direction they're going? Well, two things. How will we know if this is successful, what they're implementing? We won't know the moment, but when will we have an idea, okay, this is working?
Um, positive GDP growth numbers. Um, I mean, that's you know, if you want something objective, it's an imperfect measure, but it would suggest that we're gaining some traction. And your GDP growth figures also factor in imports and exports, so it'll help also reflect, like for instance, the GDP growth numbers dropped pretty precipitously over the last couple of months if you're looking at the Atlanta GDP now. But one of the reasons is you had a huge amount of front running on imports prior to the tariffs. So a big increase in imports has a negative impact on your GDP statistic. If they're successful with their tariff policies, if they're successful with their trade policies, if they're successful driving job growth and income growth for the middle class, it'll show up in GDP. So if we can get back to positive growth figures of 3-4% consistently, it's working.
How do you see parallels right now between what they're attempting to do and what China's model is
In what respect?
from an economic standpoint?
We're 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 kind of like moving towards each other. We've been, predominantly consumption oriented in terms of our economy, and they are like the classic mercantilists. They're making stuff and shipping it all over the world. The current administration wants to take the U.S. back towards mercantilism, even while the Chinese are still trying to migrate towards a greater percentage of uh, consumption as a share of GDP. And so, it's interesting because we want more of what they have. They want more of what we have. Um, so I think there's more differences than similarities in that respect. I think they have more latitude to make significant changes because they don't have a democracy. If Xi Jinping wants to implement policy X, Y, and Z, he just does it, right? It doesn't have to be voted on. It doesn't have to be, I mean, it's like ex cathedra from the top to everyone else. So let it be spoken, so let it be done. This is one of the reasons why as enthusiastic as I am about the Trump administration's wanting to make positive changes, we live in a democracy. It's not clear that we can get everything implemented that we want implemented without a tremendous amount of friction. Let's in the legislature and everything else. If the Chinese, who have the latitude to do what they want when they want because of their political structure, can't get the job done, they've been trying to move the needle, moving towards more consumption as a percentage of GDP for a decade and a half, and they've moved it a few percentage points. It's been an abject failure. And they can get done what they want done. The reality is, re-engineering economy is complex. And so that's where I feel like there's a bit of a there's risk attached to the brashness. We assume that somebody with a grand vision, clear idea of what they want, can get it done. It doesn't always work that way. The difference between idea and what gets implemented, in everything that happens in between, there's your risk in the financial markets. If you love Trump, you have to recognize the risk that exists between theory and actuality. If you hate him, you have to realize the risk between bad theory, because that's the way you would view it, not good theory, and implementation. In either case, whether you love Trump or hate Trump, there is an implementation timeframe gap, which is your risk in the financial markets. That's why you want to de-risk. You don't. It's a good time to be in cash. Just
Well,
looking at the way markets are trading today. Yep, it's another good day to be in cash.
what is it at right now? Can you see it?
Um, it hasn't gotten a lot worse, but Dow's off still 500 points.
Well, and this whole thing that we spent almost an hour talking about now, whether or not it may or may not work, but the whole idea, my friend Matt Bracken said this, you could train to ride a tiger, but until you ride that tiger, you don't know how it's going to go.
Yeah, I like that.
So whether or not this is going to work or not, I don't. I have no idea. I mean, I talk to people like you to say very similar things. So who knows?
It's just not a period of time where you want to be taking a lot of risk with your hard-earned financial resources. There's sufficient unknowns for you to accept that the future is less clear than it was 6 months ago, even if the long-term future may be brighter. We don't know. We don't know. So why would you choose the highest risk assets as an expression in your portfolio? This is where, again, you may be right to be long out the ears cryptocurrencies. It doesn't mean that in a period of stress and strain that risk assets perform well. It is categorically a risk asset, a high risk asset. What's its intrinsic value? Where's its cash flow? Its value is derived on more people buying than selling. If you get into a market environment, this has nothing to do with the merits of crypto. You get into the market environment where there's more sellers than buyers, all asset classes are under pressure. Your high risk assets are under the most pressure. It's tech. You come back to why is tech more vulnerable than other companies? Check the cash flow, check the dividends, check the balance. You have a, a kind of company which is made for infinite growth or no growth. This is why in the dot-com bust, you look at your Fortune 500 companies, and there were significant declines, 40 or 50%. But in tech, it was 80 and 90% or 100%. Why? You're betting on a future which doesn't exist yet, but this technology may be so transformative, it doesn't matter today because it's all about tomorrow. Then when you're in the midst of crisis, all of a sudden the only thing that matters is today. You can't even consider tomorrow. And all the future projected cash flows of infinite growth in technology, like all that gets put on hold, and you're back to what are the safest allocations? The allocations where companies are making money, the basic stuff, the really basic stuff. Don't be overextended. This is not a time frame where you want to take, risk assets have a time and a place. This is neither the time nor the place for risk assets.
Where can people find you, David?
McElvaney.com just celebrated 17 full years of our weekly podcast. And I think it's a great resource for people to sort of continue their own education. We have the precious metals business, which has been around since 1972. We've helped define the industry, helped get gold legalized back in the 70s. And we continue to help reform what is an industry that frankly doesn't warrant much of your trust. Say that frankly, the industry is rife with greed and corruption. You need to find good people. You know, we have been around for 53 years. We've got strategy, whereas other people have pricing, products, and a pitch. And we like the idea of coming alongside someone to bring, advisory and strategy, something that takes time to implement. And if we don't implement it well, we lose credibility and we're out the door. We've been around for 53 years. That would suggest that we've got a lot of clients who like us. And most of our growth comes from referrals. 40% of new clients for us, between 35 and 40% of new clients for us come from referrals, not from marketing gambits on Fox and whatever else. So we do that. We provide information and education at McElvaney.com. You can find our gold offerings on McElvaney.com. You can find a link to our asset management group at McElvaney.com. And there's some great resources there. Hard Asset Insights is a weekly thing you should read. Credit Bubble Bulletin with Doug Noland, it's something you should read every week. And then Vaulted. Vaulted is sort of our cash savings alternative. If you want to own ounces, own them expensively, and you consider yourself kind of a do-it-yourselfer, you're not interested in an advisory relationship. That's the big difference. We have the McElvaney Precious Metals, which it gives you advisory services, can help with IRAs, things like that. Vaulted, if you consider yourself a do-it-yourselfer, you can open an account, go to the App Store, download it. You'll have your account open in less than 2 minutes. Super seamless, very easy to use, very inexpensive. Try to cover the bases from super simple to very complex. Um, Michael, thanks for having me back on.
I appreciate that. And my last question was going to be, if someone, listen to this show and they think to themselves, all right, I want to hedge my bets. I want to, get involved in some precious metals. So you're saying to do it yourself, move over to, look at Vaulted. And then for a little more in-depth analysis, go to McElvaney.com.
Yeah, and at McElvaney.com, if you're talking to the folks at McElvaney Precious Metals, they can help you with, restructuring your IRA, having physical metals in your IRA, things like that. You cannot do that at Vaulted, but you can do that with the help of an advisor. And there's some helpful strategies there. There's some things that will add value. Do you pay more? Yes. Do you get more? Yes. In terms of the strategy implementation, absolutely. And you want to tap a team that has decades of experience where, sort of our junior advisors, you're talking about 15, 20 years in the business. So it's bring wisdom to bear on what is an uncertain market environment. Take it with a grain of salt, make your own decisions. We've got lots of offerings there.
Did you ever envision we'd be where we're at now in all the years you've been doing this?
Um, Rudiger Dornbusch was an economist who said, in economics, things take longer than you think to occur and then happen faster than you thought. So, in theory, when you're analyzing risk, there's lots of things that you think, well, this could happen, that could happen. But then in the midst of it, to Dornbusch's point, it's just shocking. It's absolutely shocking. It takes longer than you think, and then it's done faster than you thought possible. That's I think we're in that sort of warp speed mode right now. It reminds me a lot, Michael, of when we started the commentary, which was March of 2008. The amount of information we're having to take in and try to wrap our minds around is on a scale like that. 2008, 2009, just entering into March of 2008 was at the front edge of the global financial crisis. And every day was like taking sips from a fire hydrant. Just unbelievable. I hope that our commentary, I hope that your work is helpful for people as they're trying to make sense of the world and trying to come to some hard conclusions. How do I take and move towards practical steps? That's what we'd like to help with.
That was always my goal with this was to, well, initially it was a different idea, but now, people ask me what's your objective? And I say, I just provide information so people can make a critical and informed decision. I'm not saying everybody that comes on here is right or wrong, but that's all I'm trying to do is be objective with this. So again, thank you. And also thank you for, you're sponsoring my show, and I appreciate that, and appreciate the trust that, you've given me. So thank you.
Thank you, Michael. Till next time.
Absolutely. Mic drop.